Hello, this is Andrew Boyson. I hope you remember who I am. I know it feels like it was a long time ago when we last saw each other for those first couple of sessions of this course. Because so much has happened in the meantime, I think it's probably safe to assume that not all of you remember everything that we discussed in the first couple of sessions. So this is just a little bit of a recap to uh, get everybody back on the same page in terms of what this course is about and what we've learned so far. This is also an attempt to work out any of the kinks or problems with using Zoom in order to teach. This is actually my third attempt. Hopefully I've correctly shared my slides and everything else this time. All right, take three. This course is about corporate strategy, which means better together. As I discussed previously, the focus of this course is managing the multi-business organization, although sometimes this multi-business coordination involves multiple corporations and the businesses they own working together. Over the next few sessions, we'll be talking about different types of scope. In our first session, or rather our second session, we talked about horizontal scope and some of the synergies that go into creating value through horizontal scope. In our next session, we'll be talking about vertical scope or vertical integration. And later in the term, we'll be talking about geographic scope and how that can create value. In addition to talking about scope and why varying the scope of a firm can create value, we'll also be talking about ways of achieving that scope, and both from the growing side and the shrinking side. We'll be talking about internal development, alliances and joint ventures, mergers and acquisitions. And on the reducing scope side, we'll be talking about divestitures and spinoffs. I think all of that's pretty interesting. Hopefully you will continue to agree with that as the course continues. Our first session, the introductory session, in addition to covering the syllabus and things like that, we talked about corporate advantage. Corporate advantage exists when businesses are more valuable when owned together. But to contrast that, first we're going to start with competitive advantage. Competitive advantage exists when first you are creating value, which means that you're creating a willingness to pay for some product or service that exceeds the opportunity cost of the inputs necessary to create that. So that includes the time, your own time, the time of any workers, what it costs for their labor, things like that. And if you are creating more value than your competition, you have a competitive advantage, and that allows you to capture some value. You might have an advantage where your willingness to pay is higher while your costs are the same. Maybe the reverse, where the costs are lower but your willingness to pay is the same. Or perhaps you have an advantage on both of those fronts. But the key thing with competitive advantage is it's all about business strategy and maximizing the value of a particular business through strategy. Corporate strategy shifts that a little bit to think about the value of combinations of businesses working together and how that can be used to increase value beyond the sum of the value of each of the parts. Corporate advantage can be obtained in multiple ways. Again, corporate advantage is about being more valuable when owned together. One way, which is not the focus of this course, is portfolio assembly. So that's trying to find businesses that just by virtue of being in the same portfolio are more valuable. You can try to think of this kind of like trying to beat an index fund, except with acquiring whole companies or building whole companies. The problem with this approach is that it can be very, very expensive. especially when one of the main goals of diversification is just to reduce risk. But investors can reduce their risk much more cheaply just by investing in an index fund, for example. So not a lot of value is created simply through the combination of businesses. Instead, it's more important that they operate together to create more value. So again, we're still talking about corporate advantage here, but another way of creating value through combinations of businesses in the same firm is through business modification. This is the synergy approach. This is saying that you have businesses that are owned together and they're more valuable because they're operating together. They're creating some sort of synergy, and that might be increasing willingness to pay for one. It might be decreasing costs. And it may also be one-sided. It could be that one of the businesses is more valuable and the other business is less valuable, but the combination is more valuable than what the sum of the parts would be if they operated independently. Corporate advantage is only including those synergies that require joint ownership to create. So we'll be talking more about synergies later. And one thing you'll notice is that a lot of synergies can be created between businesses working together, even if they're not owned by the same corporate parent. If that is a lower cost way of creating those synergies, then combining them into a single business does not create corporate advantage. In fact, you have corporate disadvantage in that case. Another key thing to remember about corporate advantage is that it's a goal. It's not something that can be measured by looking at financial statements or something like that. It's really something that fundamentally changes the nature of the businesses involved. So you can't just look at earnings multiples or revenue multiples or things like that, because part of the goal of creating synergies is to increase revenue or to lower costs, increase profitability. So anything that you're trying to multiply in order to estimate the value has already been affected by the corporate synergy. So this is not something that you can measure. Instead, you need to think about how value is being created and think about what alternative ways of organizing could create similar value or perhaps even more value, and use that to argue for the existence of corporate advantage or not. So corporate strategy, we're moving beyond corporate advantage now. Corporate strategy requires synergies. It's about businesses or business units being more valuable when operated together. You can see from this figure that joint ownership is a separate question from joint operation. So you can have joint ownership without joint operation, or joint operation without joint ownership. Really, for the rest of this course, we'll be focused on those two quadrants that involve joint operation. And a big question will be whether or not that joint operation or synergy can be created more cheaply through independent businesses operating together, or whether those efficiencies or synergies can be created more efficiently with two business units of the same company working together. And the thing that determines that difference is governance costs. So there's going to be governance costs managing any type of joint operation, whether that is two business units of the same company or independent businesses negotiating and working together to create value. The question is whether those governance costs will be lower with joint ownership or without joint ownership. Two factors really drive that. There are two different types of governance costs. There are transaction costs when independent firms or businesses work together to create value. Those involve finding each other, negotiating agreements, monitoring to ensure both sides are living up to their side of the deal, and so on. There are also ownership costs. So that could be the cost of creating new resources from scratch or acquiring those on the market through a merger or acquisition. There's also the cost of managing a firm with multiple business units. Two things really drive each of these costs. One is the need for resource modification, and the other is whether or not the synergies being created are one-sided or two-sided. So one thing that you'll notice is that as the need for resource modification or one-sided synergies increases, that increases transaction costs relative to ownership costs. So if you're creating synergies that are one-sided or that require a lot of resource modification, it's more likely that that synergy can be more efficiently be managed and organized within a single firm with two business units working together, as opposed to negotiating that through the market. Session 3 will go into a lot more detail on that. In addition to determining whether or not synergies are best created internally or externally, there's also the question of how to go about achieving that internal synergy or external synergy. This is the resource pathways framework from the book Build, Borrow, and Buy. This entire book is available through the library's electronic reserves. Especially if your final project involves one of these pathways in particular, you may find it valuable to go read the specific chapter on that pathway and make sure you're applying it correctly. We'll be spending a lot of time on each of these pathways in later sessions, but a couple of things I want to highlight now that are common mistakes when using this framework. The first is failing to start with a strategic resource gap. You need to know what your strategy is and what you're trying to achieve before you figure out the best way of achieving that. If you just think about two businesses and are trying to decide whether or not they should merge, you really don't have anything to base that decision on if you don't know what types of value you're trying to create through the joint operation. And knowing that will tell you whether or not an acquisition might be the best way, or maybe it would be a terrible way of creating that value. The other extreme is the possibility of redefining your strategy. Sometimes you might come up with a great strategy that looks good on paper, but then you work through each of these pathways and try to figure out whether or not that's a viable way of executing your strategy. If you get through all of these pathways and find that none of them are viable or are likely to succeed, then it's much better to redefine your strategy to something that you can accomplish, as opposed to doing a poor attempt of executing a strategy that is not really well suited for your organization. Again, this whole framework we'll be discussing in a lot more detail in later sessions. Our session 2 shifted focus to horizontal diversification and synergies. The main synergy framework that we applied from this session was the 4 C's synergy framework. As you'll see when we discuss each of these, they are not necessarily unique to horizontal diversification. Some of these synergies also exist with vertical integration, but horizontal diversification just seemed like the easiest place in this course to start learning and applying this framework. The 4 C's synergy framework is based on 2 questions. The first is, with the synergy you're trying to create, are you working with similar resources or dissimilar resources? A common mistake in thinking about that question is thinking about the resources of the business units in aggregate and whether or not they're similar, as opposed to thinking about the synergy that you're trying to create and whether or not the resources there are similar. So you might have 2 very similar businesses that are creating value with dissimilar resources, or you might have 2 dissimilar businesses that are creating value through similar resources. The second question in categorizing a synergy is thinking about the degree of resource modification required to create that synergy. So with high resource modification, you'll remember that This can increase transaction costs relative to ownership costs. But the way that these synergies function also differs based on this dimension. Going into a little bit more detail here, the consolidation synergy is working with similar resources and high modification. So this is all about smaller. The key word to remember for this synergy is smaller. This synergy is taking similar parts of the value chain and consolidating them into a single team or a single asset, as opposed to having a larger separate teams or separate assets. This typically is done to increase the efficiency of capital allocation or to decrease costs. You can see this in a couple key ways. One of the most common might be consolidating teams that perform similar functions. So if you have two business units, they can share an IT department, an HR department, purchasing departments, and the cost of each of those is lower if that cost can be shared with a smaller team supporting both, as opposed to each of them having their own team. You can also see this synergy with physical assets or resources. So if you have two factories operating, one each for two different business units, if they're not operating at full capacity, it may be possible to sell off one of those assets and then use the other factory to produce for both business units. And that's improving the use of your capital and creating value for the firm in that way. So both of those are consolidation synergies. And again, the key word to remember for the consolidation synergy is smaller. The next synergy is a combination synergy. So this looks very similar to the consolidation synergy, but the way it works is different. This is a low modification approach. So you might still be sharing purchasing departments, for example, but the way you're creating value, instead of having fewer purchasing people, instead you have the purchasing coordinated across business units to improve bargaining power over suppliers. Similarly, at the other end of the value chain, you might combine sales activities to increase bargaining power over customers, especially if you are selling products that might be substitutes or partial substitutes for each other. So this combination synergy is all about market power. Having this and comparing it to consolidation, I think really illustrates the importance of thinking about value at the synergy level. I mentioned as an example for both having a single purchasing department that is supporting two different business units that might create value in two different ways. It could be that that team is smaller than the total number of people required if each business unit had their own team. So that would be creating a consolidation synergy. It could also be that you're using that combined team to increase bargaining power over your suppliers. So creating a combination synergy. And it's possible that you might be creating both of these. It's also possible that you could have a single purchasing department, and by not managing it very effectively, you may not be increasing your bargaining power. You may also not be reducing redundant overhead. So for example, if you have a single purchasing department, but each of those have a team to support each of the separate businesses, then you're not really creating any synergies between those. It's essentially the same as if they were separate organizations, each embedded within their business, but instead they just happen to be combined elsewhere in the organization. The third synergy I want to talk about is the customization synergy. This is about taking dissimilar resources and using high modification to increase value. A key word to remember here is co-specialization. This is all about engineered complementarity between different parts in the value chain. The example shown here happens to be vertical integration. So if you have outputs from one part of the supply chain that are inputs to another part of the supply chain, you can coordinate those activities so that they work better together. Maybe they'll be physically co-located to lower transportation costs. Maybe the way products are tagged or parts are tagged will make it easier to process and assemble those in the next part of the value chain. Essentially anything that you're doing to make the cost lower or the value higher from these vertical pieces of the value chain working together is creating this customization synergy. You could also have a customization synergy with horizontal or complementary products, but that is only true when you're modifying the products so that they work better together and create more value together. Apple sells Beats headphones, for example. They acquired that company and integrated proprietary Apple chips into the headphones so they would work better with Apple products. If they had not done that and just happened to own the headphone company, the fact that they're selling complementary products would not be creating the customization synergy. Where the synergy exists is because they modified the product so that it would work better with existing products. Finally, connection synergy. This is about pooling. That's the key word for that. Pooling resources or outputs to reduce search costs or transaction costs. A very common example of this is cross-selling or bundle selling. This is separate from engineered products to work together. So even if Beats headphones were not modified, the fact that Apple sells them in Apple stores or will be selling them again once Apple stores reopen, that creates a cross-selling opportunity and increases value by lowering customer acquisition costs. You can also have shared brands, for example, are another large source of connection synergies. So the Kirkland Signature brand, for example, is used on many different products, and that communicates something about value and the source of the product that communicates information that essentially lowers customer search costs. If that's a brand they trust, they can find a product with that brand and think less about the purchase, perhaps, knowing it's a brand that they trust. So this is a table of all of those synergies. You can spend time reading this table in its entirety, but one thing I want to point out is that in addition to the question of resource modification, we also have a line about whether or not those synergies tend to be one-sided or two-sided. With customization synergies, it can be both, or either one-sided or two-sided. One thing that you'll notice is that a lot of the one-sided synergies tend to involve high resource modification. So in that sense, the cost is coming from the need to modify the resources, but often the benefits might be realized in a different product or business unit, which realizes greater value from that investment. So with these one-sided synergies, and especially when there's high resource modification, that greatly increases transaction costs relative to ownership costs. So you'll see that these synergies are often more likely to be created within a single firm with business units working together, as opposed to separate firms negotiating contracts or agreements between them. That isn't necessarily always going to be the case, but it's definitely something worth thinking about as kind of a baseline assumption. The next framework we talked about for this section on synergies and horizontal diversification was the synergistic portfolio framework. You'll notice that there are 4 quadrants on this, and 2 of those quadrants are further divided. What you have here is on the horizontal axis, benefits to a business unit from being part of a portfolio. So Beats headphones is part of Apple's portfolio of businesses. And if they benefit from being in that portfolio, beats would be placed further to the right on this framework. The vertical framework, or the vertical axis of this framework, is about benefits to the portfolio. So if Apple also benefits from the presence of beats, that would be a fit because they would be in the top half and the right half, putting them in the top right corner. You could also have synergies that are more one-sided. Perhaps one side is realizing a cost in creating that synergy, and the other side is realizing the benefit. If the net benefit exceeds the cost, then you have either a giver or a taker, depending on which side is realizing the benefit, whether it's the portfolio or your focal business unit. If the cost exceeds the benefit at the firm level, then you have the altruists or parasites. This threshold, which divides things that are good versus things that are not, can shift up or down depending on the cost of errors of omission or commission. An error of commission is something that goes wrong because you acted, and if risks from errors of commission are high, then you want to increase the threshold for choosing to try to create a synergy. A very common example of this is mergers and acquisitions. So those can fail for many reasons. Even if the expected value is positive, you see some potential synergies there. You could have a very drawn out legal fight with the Justice Department over antitrust issues. The integration may not go as well as you expected. Maybe there's some information that you failed to find as part of the due diligence, and it means that the synergies you were hoping for cannot be created. Because of these potentially large downside risks, you want to know that the expected value of the synergy is high enough to compensate for this risk. So even if the value is slightly positive, that may not be enough to justify taking that risk. Things that can shift the threshold in the other direction are errors of omission. Errors of omission occur when something bad happens because you failed to act. And if there's a large potential downside of not acting, it may be worth doing something even if the expected value is negative, just because the potential downsides are so huge. Common examples of this might include adding new businesses, either through internal development or acquisitions that involve new business models or new technologies. Even if the expected value is not positive, if you see some potential for your entire industry to be disrupted by this new technology or this new business model, it may be worth investing just to protect yourself from that risk of being completely displaced in the market. This brings us to a couple of the academic readings that we talked about in session 2. This is one of the more complicated readings from this course. So if you have questions on this, especially after having so much time go by since we last discussed it, feel free to post those questions on Canvas. You can ask about them in the Q&A part of our live sessions, or you can schedule office hours to discuss them with me. The first reading, we discussed opportunity cost and non-scale-free resources. This idea goes all the way back to the 1950s with Edith Penrose, who proposed that diversification in firms was driven by excess resources. So for example, if they're producing something but only using half of their manufacturing facility, then they have an excess resource and they can start producing some second product without incurring the cost of building a new factory. What Dan Leventhal and Brian Wu add to this is arguing that whether or not something is excess has to do with whether or not the resource is scale-free and whether or not there is an opportunity cost. So having excess manufacturing capacity gives you choices, and each of those choices has an opportunity cost, because if you choose to pursue one path, you're not pursuing another. For example, if you think that your core product might greatly increase in demand, By using the second half of your manufacturing facility to produce something else, you're less able to capture value from the increase in demand. You could also potentially rent out half of your factory to some other company to use. So by making a second product, or by just saving the excess capacity for future demand, then you're foregoing rent on that part of your facility. So there are always opportunity costs regardless of what you choose to do with a non-scale-free resource. This brings us to the question of fungibility. So these resources that either need to be allocated or do not need to be allocated, or alternatively stated, have an opportunity cost or do not have an opportunity cost, defines whether or not an opportunity cost exists for using a resource for something new. But some resources are also more or less useful in other domains. I'll start on the right side of this figure, talking about scale-free resources. Scale-free resources do not have opportunity costs. That could include things like a brand name. The Kirkland Signature brand, if Costco adds that to champagne, it does not require removing that name from dog food. You can sell both of those products with that brand name, and there's no physical limit on how broadly it's applied. You could also have a lower fungibility brand name. So Puppy Chow is another brand that is on dog food, but that brand would be much less useful putting on champagne. So Kirkland Signature is an example of a high fungibility brand, whereas Puppy Chow is an example of a low fungibility brand. Both of those are scale-free. There's no physical constraint limiting you from applying the brand name to multiple domains. Instead, the limiting factor is how valuable or useful that brand is to a new domain. Other things that might be scale-free, which again means no opportunity cost, could include a managerial philosophy. So large companies, especially tech companies, like to talk about how they have strong cultures and ways of doing things that are valuable. There's no limit on how big a culture can grow. Whole countries and sometimes even continents have cultural aspects that are shared across them. So culture is scale-free. There's no opportunity cost in applying it. Similarly, a customer relationship is generally scale-free. Somebody actually asked a great question about this in class, about whether or not that was truly scale-free, and I think it illustrates how all of these are probably a little bit relative. I have companies that send me emails 5 times a day sometimes, and that definitely makes me annoyed with the brand. So there's no physical limit on them contacting me and leveraging their relationship with me, but there's a limit to my patience in accepting that. So it's not perfectly scale-free. On the other side, the non-scale-free resources, these are really key for corporate strategy because these are resources that need to be allocated. And that means that you really need to think about the opportunity cost of applying a resource to a new domain. So for example, I mentioned managerial philosophies or cultures as something that are scale-free. Well, that's true. Managers who have internalized a culture are not scale-free. They need to be allocated. So if you are trying to enter a new business, that requires taking some of those managers who have internalized the corporate culture and applying them to the new venture. That means taking them away from whatever they were doing previously. And that places a physical limit on growth. If you want to maintain the culture, you need to allocate managers over time, and they can only train new managers so fast. So that's a resource with an opportunity cost. An example of a resource that has opportunity cost but low fungibility would include a technical specialist. So for example, if you have an engineer that designs microprocessors, that's a very narrow specialty. You do need to allocate them still. They're physically constrained. They only have so many hours in the day and probably a fewer number of hours that they're willing to work during the day. So they need to be allocated, but they're much less fungible than a manager. They have a narrow area of expertise and their value drops substantially if applied elsewhere. So in theory, you could take that engineer and put them in a customer service role, answering phone calls or emails, but their value would be substantially reduced in that area. I use that example to highlight that low fungibility does not mean low value. It may mean low value in completely different domains, but they could still be extremely valuable in their core domain. I know that these can be easily confused. It actually happens in the real world quite a bit. So one example I like of that is Campbell's, a soup company that tried to get into the fresh vegetable business. The brands that they own are scale-free. There's no physical limit on how many new products that brand can be applied to, but their brands were much less fungible than they expected. They were applied to fresh vegetables, and that did not really do anything to increase the value or the willingness to pay for those vegetables. So that was an example of a strategy that failed. Even though they did not have an opportunity cost of the resource, they underestimated the fungibility of the resource, or overestimated it rather. I want to talk a little bit now about intra versus intertemporal economies of scope. This was the second academic reading from session 2. This is all about synergies that are being created at a given point in time versus the value of being able to reallocate resources over time, or the value of flexibility. Pretty much all the synergies that we talk about in this course, not just the 4C resource synergies, but also the demand synergies that we'll be talking about in a couple sessions, are intratemporal synergies or intratemporal economies of scope. So essentially the mathematical definition of the existence of these economies of scope are that it's cheaper for one firm to do 2 activities than it would be for 2 separate firms to do one of those activities each. So when this economy exists, you're able to create value through these synergies within a single company. The other type of economy of scope that might exist is intertemporal economies of scope. Intertemporal economies exist when it's cheaper for one firm to do one activity one year and then do a different activity the second year, as opposed to one firm doing one activity in one year and then a second firm in the second year doing something else and recreating a lot of those resources from scratch. That's the definition of this synergy. So this synergy or intertemporal economies of scope exists when that is true. It could also be true that it doesn't exist. Many companies have tried to reallocate their resources into new lines of business, and they thought that the resources would be valuable for this new venture, but ultimately failed in that, and some entrepreneur beat them. So that's an example where creating the resource from scratch might actually be more valuable than reallocating an existing resource. And the reason for that is adjustment costs. So there are a lot of things that make it complicated and difficult to reallocate resources from one use to another. You might need to do additional marketing to expand the use of a brand. You may need to retrain employees to better function in whatever the new line of business is. A lot of things that can go wrong. When you're redeploying resources, there are things that can minimize these adjustment costs. And some of those create trade-offs with intratemporal economies of scope, and others do not. Related diversification, which really just means that the resources for the 2 activities are similar or shared, does not create a trade-off between intra and intertemporal economies of scope. If you are doing two related activities, they may be able to share resources contemporaneously and create synergies of any of the 4C types, for example. And the fact that those are being shared contemporaneously does not mean that they cannot also be redeployed over time. So if you have two similar businesses and one year you want to allocate more resources to one, and then the next year more resources to the other, the more overlap there is in terms of the resources that they need, the easier that adjustment is to make. So with related diversification, whether it's simultaneous or redeployment of resources, there's no trade-off between those two in terms of intra and intertemporal economies of scope. Where you do find a trade-off is with modularity. Modularity is about taking business units and keeping the interdependence within the business units and limiting the interdependence between business units. Another way of saying that is a modular company has business units that are less interdependent or that have less joint operation. With all of the 4C synergies, we were talking about value being created through joint operation. So if you are increasing modularity, by definition, you are reducing that joint operation, increasing independence, and that creates flexibility. The more independent business units are, the more you can make changes to one, including potentially even selling it off entirely. And it will have very little effect on the other business units because they were not interdependent. But that flexibility comes at that cost of joint operation. So with modularity, you face a trade-off between sacrificing intra-temporal economies of scope to gain intertemporal economies. For any given company, there was probably a right balance somewhere between perfect modularity and full interdependence. And that could also change over time. So if the future is more uncertain, it may be more valuable to have modularity to increase your flexibility for the future. The more the future is certain, perhaps the more synergies you can create without worrying as much about flexibility. And that's it for these slides. Stop the share here. Thank you very much for listening to this. I know I covered everything pretty quickly and it was 2 sessions worth of material. I hope that you found this valuable, but definitely ask questions. You can ask on Canvas, you can email me, you can ask your peers, anything that helps you better understand these concepts, the better you are likely to do for the rest of the course. This is kind of the foundation that we'll be building on in many of our later sessions. So again, if you have any questions, definitely ask, and thank you.